Peace, fam. Hope you're having an amazing day. So now that hopefully by this video, you've seen my first video talking about what money is and how economy works in a very raw general aspect. And we're going to get into these things further depth as we go on. So this topic for today is going to be diversification. Diversification is important for investing because it mitigates your exposure. So what I say that, before I said, I'm going to give a disclaimer, none of what I say is financial advice, first and foremost. But in addition to that, I do want to say also that having concentrated wealth is where you make the most return, or ROI, return on investment. So this is also the most dangerous because you're putting all your eggs in fewer baskets, if you will. So having more eggs in fewer baskets means, hey, if I put 50 grand in a certain company, in a stock, bond, whatever it is, then bonds are a little safe. Well, that also is debatable. But if you put 50 grand or a fixed amount of income into something, then you're going to see the quickest return, the largest return, whether if you put, hey, let me put 15 here, I'm gonna put 20 there. Like if your whole nut's 50 and you put 50 into something and you lose it, obviously you're gonna be upset. But if you spread that out, you're going to have less risk if you lose in that one area. However, if you would have made, if that one company or one thing did well for you, then you would have made the most money or ROI. So I say that just to give you an idea of what we're talking about in context to the rest of diversification and what it means to diversify. So to diversify, there's a variety of different asset classes. And I'm talking from metals. When I say metals, some of my favorite, gold, silver, and there's different ones from there, copper and so on. But you also have commodities, futures, indices, stocks, bonds, ETFs, mutual funds, all that good stuff. You got real estate, you got other businesses, and then you have different type of stocks as well. So then you have like stock. When I say stock, I mean, this is kind of a general statement that I make when I say stocks. When I say stocks, I typically mean anything in a stock portfolio, which can include ETFs, mutual funds, and that stuff as well. So when I say that, it's good to diversify across a broad different things. A lot of people, when they think of diversification, are like, oh, well, I'm in stock. I have a broker account in stock for Fidelity or whatever, and I'm going to buy all these different across the 11 different financial sectors of the S&P 500. And the S&P 500 is an index. So that's a composition of 500 different companies. We'll kind of get into that a little bit later, what indexes are, not right now. So the S&P 500, though, is a good representation of the overall U.S. economy, not world economy, but U.S. economy, how overall stocks are performing, because it's 500 of some of the best companies. As the NASDAQ is 100 of the top tech companies, and US 30 or Wall Street 30, Dow Jones, whatever you want to call it, is 30 of the top companies. So what's important is when you diversify across all those different sectors and not just be too exposed to one sector, not really having more than 20% in a one sector and not more than 5% in a specific company, it's important to also realize that, hey, in this stock portfolio, let's talk about stocks for a couple of minutes. In this stock portfolio, and again, I do mean also mutual funds, ETFs, and stuff like that you might also have in that stock portfolio, or REITs, which is a real estate way to look at things, because they give good return. It's important to also have a percentage of that to be cash flowing. All of the income, all of the money that you're investing, some of it should be cash flowing. Some of them can be speculative, meaning, hey, I'm going to buy, I don't know, I can't think of a good stock, Amazon. Amazon is a great stock to buy, a blue chip stock. However, they don't pay dividends. So you're really only making money when you sell, which isn't ideal because at the end of the year, you can't reinvest that money unless you sold at a high, which again is hard to tell for early investors especially. So having dividend stocks is something that's always going to pay you. So that's like, hey, I made this money, this 20 grand or 10 grand or $1,000 or 50, 100, whatever it is. I made this money and I want it to work for me. I don't want to just put this into something and then sell it once it, tenfolds or hundredfolds or whatever it does, because then you have to pay capital gains tax on those realized gains. And that's something we're going to talk about later too. So with stock, you have to diversify across a broad thing of sectors, but it's important to realize that, hey, even though I'm diversified across this, my portfolio is diversified, I got energy, I got finance, I got, all these different things, consumer aggregate goods and stuff like that. But if you're only in stock, then stocks generally tend to perform poorly at the same time. So even though you're in different companies, they're doing different things, when the stock market tends to go down, it brings a lot of stuff with it. So that's why it's important to also be into metals. That's why it's also important to be into crypto. That's why it's also important to be good into cash. It's really good to be in cash. Always have some cash depending on the market conditions. Like right now is a great time. Again, not financial advice. Right now is a better time to be more cash because we're in a recession. And a lot of people will dismiss that or accept that thought and theory. But JP Morgan, was it JP Morgan? I forget. So a lot of the big finance people are saying that, we're working our way into a recession. So 2023, that might be exactly what we're having. So other things that you can do is having money in stores of value. So that could be things like art. It could be things like watches, not typical watches, like special watches, and like cards and other. But like I'm only into that, like 3 to 5% of a portfolio. Like you could put 3 to 5%. And say, hey, we'll see what happens here. We'll see what happens to this. And then another thing that's great to be in is to be in business, like to be as much as like 20%. I'm not 20% into anything, but I will say that like I have my own business, so a good percentage of my wealth is in my business, whether that's tools, whether that's equipments, and just things like that, or just money in a business account that you tend to want to use for business. But it's important to really have those cash flowing assets regardless, because no matter what part of your portfolio it's in, like real estate, it's nice to have real estate. You could buy land, you can buy, houses and stuff like that. But if it's not cash flowing, then it's kind of costing you money, right? You still have insurance, you still have mortgage and whatever else. Unless you buy it outright, you still have, you still have bills. So it's important to have things that cash flow. And it's a good thing to diversify across a broad different sector of things. And like crypto is a real sector that's near and dear to my heart right now, especially because how discounted it is. And I'm not talking about strictly Bitcoin, Ethereum, and some of those, tier 1 protocols. I'm talking about some of the newer technology that's quicker, more efficient, less expensive to be able to transact and things like that. Projects that have real value. I don't like getting into anything that doesn't have a real application. Like another sector, in my opinion, that's really good to get into right now is energy. You see how all this stuff is going on and how they want to shift everything to electric vehicles or EVs, electric vehicle, EV, or just different types of energy. Because we see how much coal and diesel and natural gas and all these things are polluting the environment. So there's going to be another energy source that's going to come forward eventually, if it's not already here, and that's going to be something you want to get into. Because I was looking at the top 5 families in the world. I don't remember all of them off the top of my head. The 5th one was the British, and then the top 4 were all people that made their money in the Middle East off of oil. So imagine what happens, and I'm talking about billions of dollars. Imagine what happens when they decide to take all that money and put it into this new energy sector. A lot of that money is going to bring the rest of the market cap up. So it's important to understand macroeconomics, like I said in the previous video, and economics in general, so you understand what's going on in your country, in your region, and in your sectors. Like whatever projects and stuff that you're getting involved in, whatever companies you're getting into, because equities is what stocks are. Stocks are shares of a company, so it's ownership. So you want to be on top of what it is that you're buying into. That's part of your company now. You own some of a piece of it, small piece of it, but you own a piece of it. So you want to be paying attention to what exactly is going on in that company. That being said, hopefully you found some value in this video. If you do, give it a like, a share. Feel free to subscribe to the channel to find out what exactly is going to come next. And I'll see you on the next one. More life.